Hey everybody, welcome to the Margin Makers, Dave. Thanks for joining me. This is the first one. I'm super excited. Um, Dave, you and I have been talking for some time about this idea of where these myths and these challenges lie for CEOs today who, I think as you pointed out recently, that a lot of times CEOs are disconnected from the entire sales function. And what's interesting to me is that that very space, Dave, where margin will be generated in the future is coming from the least prepared and equipped part of the organization, which is the revenue function.
Right, exactly.
So
Yeah,
you're
I'm excited to talk about this because I think it's a real gap for CEOs, the C-suite in general, CFOs also, that there is a distance between their knowledge of what's really going on in sales and account management and how that impacts their business. So it'll be great to explore this with you, Bryan.
absolutely. And from a formal perspective, the margin makers, Dave, is a sharp, unfiltered conversation. We really want to talk and work with CEOs who, as you mentioned, have been kind of removed from this idea of the sales process because we have to challenge conventional growth wisdom, not just because of AI. We've seen a lot of these challenges occur, and I think both of our current state of business happened even before AI came on the scene here. So, if you're a revenue leader that's tired of the late stage panic, right? You can't even differentiate yourself, and as we call it, pipeline puffery. This is that time, and I'd like this series to be rooted in working with CEOs, CFOs, chief revenue officers to help them see their revenue function completely different. It has to be viewed differently because this is the place where margin will be defended and won, not what we call below the line. So that's what I'd like to talk about with you, Dave. And I'm curious, where you're coming from and what your expectations are of this journey together.
Well, I think that right now is a great moment in time for CEOs, CFOs, the C-suite to get involved and take a hard look at the revenue growth engine of their companies. If you think about the amount of money and time that is spent and focused on salespeople in the sales organization, it is tremendous. And right now with AI and the disruption of AI, there is an opportunity here not only to create efficiencies, but to point those efficiencies towards the right things. There is a lot to fix that is broken. And I would say AI sort of can accelerate what's broken and amplify what's broken, or can be used as a tremendous mechanism to very rapidly sort of, course correct and go focus on profitable growth. And I think that's what we're talking about is how do we help the C-suite drive profitable growth, valuable growth, not non-valuable growth, because that's really what growth is all about, profitable growth. So that's where I'm coming from. And a lot of it comes down to, from my perspective, where sales is focused, what they're focused on, where the revenue comes from, and informing CEOs, CFOs about our perspectives. We spend a lot of time immersed in this, but they don't. I think that some of the stats are CEOs have had very little time to spend with customers, and let alone spend time with the actual sales teams and account teams. So we're here to help sort of inform and guide.
Yeah, I'm fascinated by what you guys do, and this whole idea of what AI is going to do, as you mentioned, this idea of increasing our capacity. It creates quite a conundrum because if you look at what most sellers do today, AI will replace between 70 to 80% of that effort in the next 2 years. So what we're doing is we're creating a tremendous amount of capacity, but without greater capability, you're ended up with a bunch of wasted resource. And I think that the thing that we don't want people to do is to start replacing the human seller, right, with automation, because it doesn't really solve their margin problem. So we're going to come back to this, hence the name, the margin makers, because where margin growth is going to happen is going to be what we call above the line, right? What the market rewards you for, because AI is really squeezing the life out of the below the line margin. So I don't want to give away all of our thoughts on this first. I want to work this through. And some of the things you were talking about, Dave, earlier was, hey, there's these myths that are out there. Let's start addressing those. What if we just start cracking away at those and helping us start seeing this revenue function differently, not just as a means to an end, but a means to create greater margins, which create healthier organizations moving forward. Hence, CEO, CFO, CR having a real keen interest in what we had to discuss.
Yeah, absolutely. I think when when you get into what most CEOs and CFOs and the sales organizations are accustomed to, right? There is a tremendous amount of focus on reading dashboards around transactional sales volume. How many transactions are we processing through in different groups? And it's sort of an overwhelming sales consciousness that pervades the entire sort of organizations today. And you're right. What's happening is AI is going to basically automate a lot of those transactional sales. Those are low value sales. Those are pot and pan sales. They're lower, they're lower priced, they're lower deal sizes, right? And the margin's more compressed, and it's going to get compressed even more. And that's sort of low-hanging fruit. But we got to talk about the other side of the equation, which is the strategic sales. That is where the human in the loop, the salespeople that add value to customers to solve their problems and address critical needs, are critical to driving high value, high margin sales. And that's kind of the domain that I come from, which is focusing on, I'll call it myth number one, all growth is good growth, first of all, is a myth that I think is pervasive in sales today. It's not true. And I've got a great story about this, but you're really after high value growth, profitable growth. Unprofitable growth drags down earnings per share. So, I've had the chance, in one of my experiences going back 20 years, and this would probably resonate with a lot of CEOs, CFOs today, but we had McKinsey come in, and they were examining the portfolio of companies that we had as customers, and the findings were pretty striking. But the top 10 clients out of hundreds and hundreds and hundreds of customers, think 1,000, 1,200 customers, the top 10 drove 70% of the margin of the company and 50% of the revenue. The top 10 organizations. I call this the economy of key accounts. The bottom 300 customers cost money. And so the course correction that was being recommended was you should only focus on these top 140 companies in these 5 verticals, on these 5 to 7 different buying centers, and focus on the 1,400 executive relationships that exist there. And you would dramatically increase not only your revenue, but the profitable growth of the company and the earnings per share. And there was no mechanism for the C-suite to do that. Fast forward to today, there is a mechanism to do that because you can really focus and do a lot of insight-driven growth. But that lesson has always stuck with me because you really want to be driving, right, the top 10 type of, make that repeatable and not go after low margin, low value business that's going to ultimately cost you in the end.
Yeah, that makes a lot of sense. And I think even without that segmentation, right, the 80-20, it just continues to prove itself out. It's almost like the fear of letting go unprofitable work, which is funny to me. I'd like to take it. You mentioned this idea of metrics and what we track and what we monitor. And when you said all growth is good growth, I have a little bit different take here, additional take. And that is the difference between revenue and margin. And when I work with CEO groups around the world, do you want revenue or do you want margin? They used to be somewhat intertwined type of conversations, but they're two completely separate concepts here. And I think it's going to change things dramatically because we can drive revenue, hence your 70% are just too insignificant, versus focusing on driving margin. In the margin, when you say unprepared, like I don't know where to hunt, but more importantly, I don't even know how to defend our value. So when you think of margin being important, sales velocity I don't think matters, right? Because your example, I could be selling a lot of the wrong things to the wrong people at the wrong time, and we might move to something like margin velocity. Right? Sales velocity is how much do you sell on a daily basis? I'd like us to think about how much margin you create for the enterprise or the organization on a daily basis. So this idea, so what you're saying is, hey, if we believe that there's this margin creation ability in sales, you're saying, why are we wasting all of our time down here when right here is where all the margin growth lies, and that happens to coincide with your biggest customers?
Exactly. Yeah. It's an important dynamic because, as I pointed out, the Global 2000 represents half the world's economy. It is equal to half the world's GDP in terms of revenue. You take the global 3,500 and the top 1,000 private companies, and you have the 80-20 rule, which is this very small percentage of businesses drive almost all the spending, all the B2B spending. As it is right that in a portfolio of sales customers, using AI to automate the transactional side of high repeat, high transaction volume sales is the right thing to do. You're taking out costs below the line. But on the other end, with these large accounts, where what I call the invisible pipeline, this huge potential for growth, you really want to engineer the sales organization, the people, to be focused on different things. I think commissions, the whole commission structure that the C-suite supports and the assignments that the teams are given are fundamentally wrong. I mean, if you incent people to sell a certain amount of revenue, say $1 million, and you let them sell anything against that $1 million, what are they going to do? They're going to gravitate towards the lowest value sales that are the easiest to make quickly. They'll hit their number and they get paid on selling the wrong thing. No one tells the sales team, I'm going to reward you for selling high margin deals or high value deals to a customer.
Why not? What keeps them from that, right? Because let's think about this, and maybe this is part of the challenge moving forward. If we believe margin is the oxygen for an organization, and margin can be created above the line, where we can get the world to I look at value and margin the same, right? It's how relevant, how vital, and how valuable you are to your prospect really determines your margin, right? Because if this is price-based decision, what they're really saying, Dave, is you offer no value whatsoever. So when you think about the rewards and the incentives, you're exactly right. Why am I rewarding revenue when margin is really my driver of the business? So what if we simply replaced revenue with margin, right? Why can't we incent those margin behaviors? Because what's good for the situation there is better for the enterprise anyway.
I totally agree. I mean, and now's the time to do it, because if the transactional piece is getting automated, all of the margin that remains to the point of this entire podcast is really above the line, right? Where are you going to make the margin? Well, it comes from solving high value customer needs and problems. Big organizations have a lot of problems to solve, but that's where you get into aligning capabilities towards solving the problem. And this is where executive buyers are very frustrated. Executive buyers look at their suppliers and vendors and say, you are not good at aligning your capabilities to solve my problems. And the sales is not incented to do that. And I think they go hand in hand, which is higher margin comes from higher value impacts to a customer.
Yes.
Solving a higher value problem creates a higher value solution, and both parties gain in that value exchange. The supplier gets a higher margin deal structure, bringing real value to the customer gets a higher impact, a higher return. That is where margin's going to be made in this post sort of AI future world, I believe. And that's really where, CEOs need to pay attention to this.
What's funny about that, Dave, is you're right. And I think the problem, because you mentioned pre-intent, and I want to come back to pre-intent in a little bit, because I think this starts unlocking where do you get better margin, because not beyond incentives, think about this whole buying journey. I have a slide we use, I have this race to the bottom. And depending on where a prospect is in their buying journey, right, determines how much margin you're going to create. And this is a downward slope called the race to the bottom. And what we found is that by time a seller enters the prospect's mindset, they're well into their buying journey. I know what I want as a prospect. I know what I want. I know what I'm looking for. I'm talking to 2 or 3 competent and capable providers. Well, guess what? You're showing up at the 83% mark of that buying journey. And there's very little margin to gain, but that's where your leads come from. That's where your referrals come from. And I think this is where human sellers are most vulnerable, because I don't think they're that necessary moving forward at the same point where margin is probably at its lowest. When I work with sales teams, this is somewhat blasphemous, but I'll tell them that the worst time to enter the sale is when the prospect's looking for a solution from a margin perspective, not from a sale, but from a margin perspective. So here we have this wrong incentives. We're going to reward revenue, not margin. And then my entire business development function is focused on finding needles in haystacks, finding opportunities when website leads come in or when I get a referral to someone else, and all the things that were good for us as sellers. What we now have to think about is that's the worst time to enter a sale from a margin perspective.
Exactly. That's the last time. You don't want to spend money on human resources entering the sale there because you're probably going to lose the sale because it's too late.
Well,
And even if you win it, it'll be low margin.
yeah, exactly. And think about these ages. And one of these upcoming topics, I'd like to talk about the three eras we've been through in the last 3 decades, which have been three fundamental paradigm shifts that people our age are contending with. Right? We entered the work world at the end of the industrial age, right? Companies were making things. We needed salespeople to go educate, get in front of buyers, and tell them about our product or service. This is before the internet, late 80s, early 90s. Then all of a sudden the internet comes along. And now we have information coming from all different directions. Website leads start coming in, but our buyers were inundated with information, which is hard on our brains. So salespeople were then needed to help them kind of sort through, cull through all this and help provide some guidance at that point. But now with AI, we're entering the answers age. So we've gone from the industrial to the information to the answers age. And all of a sudden, the role of the human seller is not anywhere near valuable like it used to be. And that becomes your problem, right? Because if I'm waiting, Dave, for deals, opportunities to show up at my doorstep, I'm so far in, they're so far in, and so late in the journey that there's no value left. So talk to me about pre-intent because I see this all the time. When I preach this, if you're going to be showing up here, that's way too low, way too late. They ask, what do I do? How do I start a buying journey with someone who's not actually looking for a solution at a high level?
Yeah, well, that's a great segue into the whole discussion about these pre-intent signals. So if you think about customer needs, right? So first of all, the worst selling sort of rhythm, the thing that's being outsourced is territorial sales assignments. Just go sell any business, anything over here.
That is totally industrial age thinking.
Yeah. So that's, if you're doing territory still, that's way outdated, and that's use AI to automate, transaction sales. Then you get signals, right? Purchase signals. But purchase signals are too late in the buying cycle. I mean, if you're getting those online, you're getting those from somebody's raising their hand on the internet that they're looking at something. Well, all of the decision making's been done. All of the major purchasing around who's going to be involved in this big initiative, because customers fund initiatives to solve a problem or a need. The funded initiatives is what you're after, and you want to get in early to be part of that initiative. But if you're picking up signals after all that's been done and it's what's left, they're looking for piece parts to fill in. And executive buyers can do that on their own. I mean, there's all sorts of stats about this, but 81% of buyers are unhappy with their experience, even when selecting the winning vendor. Most of the buying decision is over by the time that, the signals picked up, like 85%. I mean, the chances of winning anything valuable based on signals is poor. So pre-intent signals is what we focus on. And this is when the need is originating. It's before the client is spending money creating a funded initiative, but it is tied to, major situations that affect these big organizations, legislative changes, security threats, environmental threats or risks, acquisitions, major new product launches, things that go on all the time. And I think what's missing from the pipelines, what I see all the time, is we have this massive pipeline of pre-intent signals showing up on these huge organizations. Think of the Global 3,500. There is a lot of these pre-intent signals, but the pipeline doesn't have them in there. The salespeople don't know about these because they're not aware of these happening.
When do they know? They find out at the 83% mark, which could be weeks
Right.
and months later.
So you got to flip all of the sales should originate much further upstream, early, before the buying has started, not at the end. But CEOs need to pay attention to this because your sales models are built the other way. They're built to pick up signals and assign people to territories and not search insights for these pre-intent signals.
I'll go back to the whole thing about, because paradigms fascinate me, and paradigms, for those who may not know, it's how we win or lose based on the rules and boundaries established. Right. So based on certain rules and boundaries, you have winners or losers. I love baseball. So the baseball season, right? Pitchers are dominating the game, right? So, you win championships and World Series with dominant, healthy pitching. But what if they move the mound back 10 feet? Let's change a rule. Let's change a boundary. then what it takes to win a World Series now going to be the same as it used to be, because now you've completely or probably shifted the balance toward the hitters. And all of a sudden you have to think about winning, or you have to win or lose differently than before. And I think that's the real issue. And while in sports they can control that, but in the world we live in, as you see this acceleration going on, we have these new paradigms emerge on a consistent basis. I'm just talking about the last three and how significant of a paradigm shift it's been, going from the industrial age to the information age to the answers age. But what affects our brains, Dave, is what we call paradigm paralysis. I hate to give up what used to work because I could depend upon it. And we stay stuck in these old mindsets, driving revenue, commissioning revenue, territorial design, because that used to work. And I don't know why it doesn't work anymore, except it doesn't work faster because of the accelerating curve. And so this idea and this shift, I don't think this is, hey, over the next couple of years, I want you to rethink this differently, because margin is what's in play now, not revenue.
Yes. And I think that there's another myth I would bring up at this point,
There you
which
go.
is that revenue comes from sales. And this is, you brought up baseball, Moneyball, right?
There you go.
You know, wins come from hiring the better players. No, they wins come from runs. And how do you get runs? You got to get on base. And how do you get on base? Well, this is the whole paradigm shift you're talking about, which is revenue comes from customers. It doesn't come from sales. Everybody's so busy, and CEOs, CFOs, everybody's looking at the wrong thing. You guys are looking at salespeople and sales efficiency tied to assignments that are wrong in the first place. You're not looking at the customers, the accounts. They write the checks. That's where the revenue comes from. And if you want to get higher value revenue, bigger deals, I mean, much bigger deals. You know, some of these deals, I mean, if you can get a deal that's 40 times bigger than your average deal size, that replaces 40 new sales.
Well, when you think about when you're brought in, if you're brought in low and late, let's try something, let's move slower. And I think that you're selling, when you're selling when the prospect's buying, that's really the wrong level, wrong conversation, wrong people that are a bit cautious, versus I think what you're saying is we get an early at a higher level. There's some bigger swings there, right? There's some real opportunities there.
That's where the bigger swings are, and that's where the alignment opportunity is so, it's sitting right there. You know, there is so much frustration on the buyer side that vendors can't align their capabilities to solve these problems. CEOs at the buyer want help solving problems. They're begging for help. They have to do it themselves. They're frustrated with their own companies' inability to solve their own problems. If somebody shows up in the moment that they're addressing a problem and says, I can help you, we've worked in similar situations, we have some perspectives, let's work on this together, they are all ears, and they reward vendors with big deals, faster deals. And we see this all the time. And if you're the only vendor standing in that room having that conversation early, you are going to do very well. I can tell you that, because no one else is in the room. And by the very nature of no one else being in the room, you're the one co-creating the solution with the customer at a moment of need where they have to fund that solution. And that's what they're in business of doing. So it's about timing and alignment. And that's what's off. And that's what companies and CEOs need to get involved. Like the general manager of Moneyball, they got to get involved in looking at the team and what the team is assigned to do and what they're fundamentally incented to do, and rethink where they're focusing the human capital, to your point. Because again, sales come from solving problems for customers and meeting their needs. And we see research point to that fact that executive buyers buy only when their needs are fit to a solution that solves that need. Otherwise, they just won't engage.
Yeah, I'd like to add one thought on alignment, then we'll move to the next myth there, is this idea of alignment. I completely agree. And in a future episode, let's talk about the human brain, how it makes decisions, because I think there's a real support to what you're saying. People want to buy things that make their threats go away. In fact, when you're selling properly, it's really their purchase, not your sale. Because whenever you're closing, or you see so many, even the groups offering sales training and coaching day, it's still for a previous, it's back to the previous years and decades, closing and handling objections. You're at the complete, which means no alignment to me. If I'm handling objections, that means there's no alignment. If I'm closing, there's no alignment, because when you're in the right environment and you're really addressing a threat that someone has, they want to buy what it is you're doing. The question is, do you want to be with everyone else at the very bottom, or do you want to drive engagement and alignment at a much earlier to higher level when no one else is? I think that's the key to what you're saying.
That's exactly right. And I totally agree with exactly what you're saying, is that the perfect sale is really when the customer's buying and you're not selling at all. And a lot of times you're getting out of the way and basically creating that alignment. That's really the job of what the seller is helping to do, is making that alignment easier. It's getting rid of any of the sort of making it more seamless experience, being there, to coach along the way. But buyers react incredibly well to this. They love this. In fact, when we put sellers in front of buyers with the insights around pre-intent needs, the buyers are actually like grateful. They even thank the sellers for showing up in full. Yes,
this isn't. We're just nothing but selling future episodes. Please come back, because I think there's some thoughts I think really important to go through. And this idea of alignment, because I don't think there's a listener today that will say, "Boy, that doesn't make any sense to me." Here's the sad fact, though, that only 10 to 22% of salespeople today have the ability to have that conversation you're talking about. And when you look at of all the thousands and thousands of sellers that we've assessed and identified, the vast majority are stuck further into the buying journey that don't currently have the capability to do what you're talking about, which is why you shared that statistic of misaligned meetings, why people don't want salespeople calling on them, because they can't align to what really, really matters to them. And so you're having this huge portion of your sales function that's not equipped or prepared. And all of a sudden, AI creates more capacity with that bottom 78 to 90% of your sales staff. And increased capacity without capability creates the problem. Because what I want more than 10 to 22% of your human sellers to have the conversations you're talking about, Dave. I want 75 to 80% of your human sellers to be able to have those type of conversations. And if we don't change that, it's not about saving money on salaries in the future. It's about surrendering margin to your competition, because their sellers get there first, fastest.
Yeah. And what I would tell CEOs and CFOs is you have got to make it easier for the account sellers to align capabilities to solve client problems. If you have everything so compartmentalized, fragmented into little pieces, they're not in a position where they can align these pieces easily. You hear executive buyers, they'll complain, "I don't understand why they can't put these pieces together for me. They're making me do all the work. I have to figure it out." Big organizations, it's not the seller's responsibility to do that. This is where marketing, solution engineers, just the way that you package and frame capabilities to align to solve problems, that is a critical area CEOs need to focus on, because it's too hard for the account seller. So even if the account seller can put together a great story and value alignment and even package all the pieces, they're often prevented internally from bundling those together by these constraints. They're told, "Oh, you have to work with that separate division to get permission to do that." And by the time they have to go through all the rigmarole internally, the client's moved on. And this is where big deals are lost, as well as could have been won. So CEOs with AI, you can make a lot of this streamlined if you simply embrace shifting, to a Moneyball type of play where you're focusing on alignment to customer needs, not how I can, focus on sales only performance based on the CRM dashboards.
Yeah. Yeah. As we start winding down this first episode, a couple thoughts, Dave. One is we've covered this idea we cannot live on this race to the bottom, right? That's where everyone else is. There's no margin left. And I just don't think there's room for the human seller there anymore. I just don't.
I agree.
The only way you can counter this race to the bottom is with a sprint to the summit. And I've been thinking a lot about this, right? Because if my sales team can't get earlier access at a higher level, and my competition does, my competitor now wins the margin. I'm fighting for what leftover scraps there are. And knowing that margin becomes the oxygen or the driver of our business, I don't think we can afford to let that happen. And from what I understand about pre-intent buying signals, and here's how I see it, Dave, is would I ever want my competition having some of those insights you're talking about and I don't. Knowing there's only room for one, there's a zero-sum game at the top. Down at the bottom, they'll take proposals from whoever wants to waste their time doing it. But when it comes to that rare air, high level, the right person, the right message, right environment, there's only room for one. And I just don't think if you have an unprepared, ill-equipped, and underdeveloped sales team, that you're going to be able to pull that off. So I think there's real emphasis
Totally.
around this pre-intent that I'd like to explore in some future episodes.
Yeah,
Your final
I
thoughts?
totally agree. I think Sprint to the Summit's a good name for it. The margin, your margin is in balance with the customer's outcomes that they're going to gain from your solution. So
Absolutely.
bigger outcomes, greater margin, and being in early to package those teams and align those things together is critical. And I think that becomes, I think some of the exclamation point of this episode is margin can be made above the line. You're going to be using AI to automate transactions, but once that's done, where else are you going to go to drive profitable growth? You got to get into this. And what I would say is if you don't and your competitors do this, you won't just lose big deals and margin. You're going to lose entire customers quickly.
Yeah,
You're
because
going
we
to
haven't
give up
got the
the
management side of the business. That's a whole nother
yeah.
conversation, right?
Yeah, and so it really is important because if you don't move quickly now, those that move earlier, faster are going to be occupying the mind share at high value accounts that spend the most. And one final thought is I think for CEOs, the level of penetration that companies often have in big accounts is much smaller than they think. I have one example of a client that it's in the staffing space, and it was like they were pretty proud of the revenue footprint that they had, and it turns out it's something like less than 2% of the total spend, outsourced staffing services of that client. Less than 2%, and they're not even aware of it.
They had it going on.
Yeah. So it's remarkable, that there's huge opportunity for profitable growth in the right companies, the right accounts, when you apply the right techniques and alignment approaches to it and instrument the teams beyond their skills, but also make it easier for them to do this job. And so that's why we want to focus on informing CEOs and CFOs. Be aware of these things. Think about your role in helping to reset, where to focus these teams and spend time instrumenting the revenue function of your business, because it's going to pay off significantly, or it's going to hurt you if other people in your space do it before you do.
Yeah. So what I'm hearing you say here is that we're not asking anyone to invest more. I think it's just a reallocation of how we view this revenue function. And I think the fundamental shift is let's get off of revenue and focus on margin, which has you looking at how you behave and act much differently. So I want that to be something we take away, Dave, and think about margin creation, where it's won, how it's best defended. So let's call it a day here. I think that this next episode, I want to talk about value compression or margin compression, because I think that's the real silent killer that if we don't start actively combating and dealing with, I think it's going to compound our problems faster. As we talk, this world as it continues to accelerate right in front of us, right? It doesn't leave us a lot of options. We can sit back and do nothing, which I know is not the most attractive thing, blow everything up and start over, which doesn't seem too attractive either. But Dave, I want to be laying down a path. What things can we do to make sure that we don't fall further behind faster because we didn't grasp this idea of margin creation and then focus on where, when, and how my team enters the sale?
Right. Totally agree. Look forward to that.
All right. Well, for now, thank you, Dave. I appreciate the time, and I hope you all enjoyed our debut episode. We look forward to future upcoming content. Drop us a line if you have any questions or you'd like to appear as a guest. I think part of the success here, Dave, is let's hear what CEOs that have made this transition that start seeing the revenue function differently. And I think it'll be helpful for us all.